The Get Rich Slow Club podcast is a collaboration between Tash from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Hello and welcome back. Today we have Brandon from New Money with us. Who are you, if people don't know?
Who am I?
Yes.
I'm just a dude on the internet.
Who does what? Why are you relevant? Why are you here?
Why am I relevant? I don't know if I am relevant. No, I just make YouTube videos on the stock market and investing on my YouTube channel, New Money, and have been doing so for the past 7 years, and run the podcast, the Young Investors podcast with Hamish Hodder, who sadly couldn't be here today. But
we did invite him, but he declined. Things going on.
Yep, he's got stuff going on. So unfortunately, we can't have a chat with Hamish today. But how you doing? Good. We've got one half of the Young Investors podcasters, so that's fun. What kind of YouTube videos do you make? Just stock market, finance. I, as we'll talk about today, I'm a value investor at heart. So I like to talk about kind of the big value investors of the world, Warren Buffett, Monish Prabhai, those kind of guys, and what they're up to. And that's pretty much what I do. Awesome. Well, before we talk about value investing, because it sounds very interesting, do you have a money win or money loss for today? My money win is free dinner last night at your book launch. Yes, yeah. I had my book launch last night in Melbourne, which is very exciting. But yeah, because you came and hosted our Q&A, you got a free ticket. So we had lots of canapes and a few drinks, which was really fun. Yeah, it went well. How'd you think it all went down? Yeah, it was good. It was fun. Everyone was really friendly. Everyone was excited to be there. So that was good. Yep. How'd your signature go? Oh, I've been practicing a little bit on books last night and on a few little note things, but no, it's a bit messy. It's hard to sign a book because your hand's quite raised up on the book. Oh. And then when you kind of your wrist goes off the end of the page, it's hard. Right. It's a skill. Author struggles. Still developing it. But now it's out. Where is it? Is it everywhere? Yeah. Big W, Amazon, QBD, not QBE. That's what QBE. I keep wanting to say. Yeah, not the insurance provider. Yeah. Dimix, where is it? Yeah. Nice. Did I say Big W? No, Big W. That's exciting. Yep. Yeah. Yeah, we saw it in Big W yesterday. Everyone can go and buy it. Yeah, very exciting. My money win is that Perla sponsored our event last night. So Perla obviously own half this podcast as well if you've been listening, but they also offered to sponsor the event, which is very exciting. Thanks, so I didn't need to spend, book launches are really expensive. So oh, really? Yes. Right. I guess venue hire and all that sort of stuff. Yeah, $3,000 to $5,000 to hire the venue. And we were selling tickets for $20 or $15 each. So it's pretty hard to make your money back. Also the staffing costs, Perla helped to organize it. All the time you spend setting things up, negotiating backwards and forwards. It's expensive. So yeah, crazy. Thanks Perla for sponsoring. Yeah. Thanks Nick. Thanks Hayden. Thanks Perla. Nick and Hayden came yesterday. That was cool. Yeah, they're great guys. Yeah. I had a good time. It was awesome. Yeah. And a good turnout as well. Yeah, heaps of people came. Back to value investing. What is value investing and what is valuable about it? What is value investing? Yeah, value investing's it's about straying away from passive investing. It's about What's passive investing? Passive investing, buying ETFs, tracking the market, accepting, the average return and loving that. It's kind of stepping away from that, and it's looking more at analyzing individual businesses. And it was originally made popular by a guy called Ben Graham, who you guys probably know as the author of The Intelligent Investor. But that was a long, long time ago. But it was really popularized by Warren Buffett. Well, still is very popular because of Warren Buffett. And it's the strategy that Warren Buffett follows and he's kind of tinkered with. And now everyone kind of idolizes Warren Buffett, and we kind of value investing has kind of drifted towards that Warren Buffett approach. But what actually is it? So you've got ETFs are part of passive investing. So you buy something, you hold it, and it just ticks along in the background. What do you actually do with value investing? I mean, value investing is that it's so individual to everybody. There's no one value investing approach. So obviously I said Ben Graham started the approach, and then Warren Buffett kind of took it over. So we kind of all followed this Warren Buffett strategy, but value investing as a whole is just trying to find good businesses at suitable prices. So it's buying individual businesses. Buying individual businesses. Yep. Going out, doing your homework, finding ones that resonate with you that are within your circle of competence and waiting. There's a lot of waiting. It's just waiting until they come on sale. You can get them at a fair price and holding them for the long term. So it's still a long-term strategy like passive investing, but it's a little bit more hands-on.
For an active one, would you say it's active investing? Yeah.
Yeah, it's active investing. Yeah. If we define, passive investing is just accepting average and tracking the market, and active investing is doing your own thing and straying away from that.
Hoping to get better than the average.
Yeah. So I think active investing can be anything that isn't passive. So it could be buying, gold, or it could be buying crypto or buying stocks or whatever. Value investing is more about analyzing businesses and trying to buy wonderful companies at fair prices.
Yeah, and it might be confusing because you can buy actively managed ETFs or actively managed funds as well. Sometimes that's like passive versus active management, but this is a bit different. You mentioned Warren Buffett. What actually is his approach to investing?
Yeah, Buff Daddy.
Oh no.
as we call him. No, Warren Buffett's approach, there's really 4 key pillars to his approach. You start by understanding the business. That is the all-important first step. So you can't move forward unless you are dealing with a company that is within your circle of competence.
What circle of competence?
We'll get there. Okay. And then from there, the second step is to look for companies with durable competitive advantages. So they call that the moat around the castle. Step 3 is assessing the management. So looking at the CEO and the management team and making sure they're operating with skill and integrity. And then the fourth step, the all-important fourth step, is the valuation, making sure that you're buying a good company at a good price. Mm-hmm. Yeah.
So circle of competence, what does that mean? So many things, so many
flying.
questions.
This is quick fire. So the strategy starts with finding companies that resonate with you. So a lot of value investors go wrong because they start messing around in stuff that they don't understand. They kind of put valuation first and they put understanding the business last when it should be the other way around. So my view anyway is that you have to understand the business and it has to fit within your circle of competence. And there's a good kind of way that a lot of people say, well, how do I know what's in my circle of competence? Because obviously as an investor, if you're new to the game, your circle of competence starts with nothing. But this is kind of more Peter Lynch vibes that you already know a lot more than you think about some companies just from what you do, where you spend your time, where you spend your energy, where you spend your money. So he's very much of the opinion that you should look at, what sort of companies do you just encounter in your everyday life.
Are you talking about things like ANZ, Woolies, Coles, Big W, those kind of things where you see them out and about every day?
Yeah, I mean, it's really individual to everyone. So there's stuff that we all kind of bump into every day, like the Woolies or the Coles. But also like for me, for example, running a YouTube channel, YouTube is owned by Google. So Google might be one of those stocks that I don't say I understand it now, but if I did some homework, I could understand it. It's about figuring out what you could understand. What would be another example? I don't know.
My dad works in mining. I would never buy a mining stock, but because my dad works in that industry, he understands it. He understands what's probably going to do well. So he buys mining stocks. Yeah. For me personally, I know nothing about it, so I wouldn't do it. Or you bought Tesla. Mm-hmm. You were really interested in it. You were a bit of a fan. How was that in your circle of competence? Yeah.
So I've always been interested in renewable energy and electric vehicles, and I'm a bit of an Elon Musk fanboy. I love what he does. I was finding myself logging in and, designing cars on the...
How do you design cars?
Yeah, like on the website.
What do you design? Like you change the color?
You change the color and look at the different...
It.
Like I knew so much because I just did this stuff out of curiosity. So naturally taking that leap and looking into the business more wasn't that difficult. They have so many factories and they have so many parts of their business. But for me, I wasn't overwhelmed by that because I kind of already knew because I was just so interested in it. It's the same like some people love video games. So looking into a Take-Two Interactive and understanding video game development and the slate of new releases. Some people already know the new releases coming out over the next 5 years from Take-Two Interactive without even having to look into their financial data or anything like that. So it's just about finding stuff that's in your wheelhouse, I guess.
Yeah, when you already know the competitors and what they're up against. And I guess the same as like with Pepsi or Coca-Cola as well. Like if you were really aware of those companies, maybe they'd be in your circle of competence.
Yeah, definitely.
You drink a lot of Pepsi Max, I know. Would you invest in Pepsi?
Just me?
We both drink a lot of Pepsi and Diet Coke, yes. Would you invest in a drinks company or no?
I mean, maybe. That's one that doesn't get my juices flowing. So I think a part of circle of competence is you have to stick. Yes, you can encounter a lot. Like everyone has a bank, right, that they bank with. But for me, banks don't interest me. So while I can say, I encounter banks and I kind of understand how banks work, when I open the financials of a bank stock, I'm probably going to get pretty bored pretty quick. So while you could make the argument that, we all drink water, and whoa, there's some water companies that there's some stuff that's just not going to take your fancy. And if you're looking at stuff that you're just not interested in, Warren Buffett's approach is definitely just to leave it, move on. He has on his desk, he has a too hard pile, and he just reads all day. And so much of his stuff, he just opens it up and it either doesn't take his fancy or he doesn't understand it and he just chucks it in the too hard pile. This is the best value investor that has ever existed. He's worth, I don't know how many billions of dollars, probably over $100 billion at this point. And still, he's done it so successfully, averaged 20% per year since 1965. And there's so much stuff that he picks up, opens it up, says, you know what, I'm great at understanding companies, but I don't get that. He puts it in the too hard pile and he moves on.
Yeah, I just want to disclaimer something quickly. Warren Buffett is considered the best investor. So 20% returns every year is not normal and it's really hard to achieve. In the next episode, we're going to do one about whether or not you should actually do this or how to decide between ETFs and value investing in individual stocks. So maybe just keep that in mind as well. But so someone wants to start, they want to value a company and see if it's right for them. We've gone outside, we've looked, we're like, maybe like Tesla. I've looked at Big W, I've looked at Coles. Mm-hmm. How do you actually find which one is right for you though? Is it just the circle of competence stuff?
Yeah, so we go back to the 4 key pillars. So circle of competence and understanding the business is definitely the first step. And then after that, you go, okay, once you've got something and you're like, yep, it's in my wheelhouse. I could understand that if I put the effort in, then the next step is to actually go and start reaching it. And
how do you research it?
A part of that is looking through the annual reports and that kind of thing. If you're looking at stocks in the US, they have a great, the first thing in that annual report is just a massive, simple disclaimer and explanation of what their business is, what they do, how it works, what the risk factors are. So you can literally just pick up an annual report and just read through. Eventually you get to the financial data and that's a little bit more tricky to kind of wrap your head around, but that's when we start talking about the second key pillar, which is trying to find a company with a durable competitive advantage. So we can take the example of Pepsi versus Coke. And I can't remember when it was, but there was just a blind taste test done by Pepsi, I think. I can't quite remember, but the result was that in a blind taste test, most people prefer Pepsi, which is wild. But Pepsi it's no way coming for Coke. Coke is so far ahead.
Yeah, people are like, oh no, they just serve Pepsi. I'm not going to go there because I prefer Coke, which is interesting. But then there's so many ads on social media about Pepsi recently, which I find interesting too.
Yeah. So Pepsi's always been number 2. Actually, I think it's number 3 now because I think Dr. Pepper just overtook it.
Really?
Yeah. But so there are these companies that have, for some reason or another, have a competitive advantage. And there's all sorts of competitive advantages out there that you can look for. And the first step is trying to just research the business and understand what the competitive advantage of this company might be. So I'd say for Coke, the competitive advantage it has is a brand moat. It just has an unbeatable brand, as shown by that study where most people prefer Pepsi, but most people buy Coke. You can look at a brand like Apple. Apple has also worked a lot on a switching mode, and a switching mode is where it's essentially an ecosystem mode where you get so locked into an ecosystem that it's incredibly hard to move away from. A lot of software companies.
I think we've all experienced that when you have your iCloud, you've got your photos, you've got all your apps. When you get a new iPhone, it literally just transfers everything over and it's so easy to stay with it.
Yeah. You can buy a phone that's cheaper with the same specs, but you don't.
Oh, but iPhone's just so good.
Yeah, I know. But why is it good?
Yeah, because it's uncomfortable to go back to a different one. Because I used to switch every year. I do an iPhone and then I do Samsung, and then I got to a point where I was like, oh, it's just easier to keep buying iPhone.
Yep. Yeah. So there's a lot of moats out there. There's secrets moat with patents and that kind of thing. Yeah. When a company's got a patent and they can't be.
Oh, Invisalign used to, but now there's lots of other companies popping up like Invisalign.
Yep. Yeah. So that can help a company stay ahead. What are some other examples? Switching
going back to the phone one. Yeah. I remember there was that BlackBerry kind of movie documentary thing.
Mm-hmm.
How would you have identified that as did they have a moat? Did they not have a moat? Were there too many competitors for them to have had a competitive moat? If you think back to BlackBerries with their keyboards.
Well, what are you saying? Sorry. So
we're talking about iPhones and how they have a switching moat. If you're looking at phones in general, and we're thinking about BlackBerry and how they had their big downfall a little while ago.
Yep.
If you were looking at BlackBerry back then, would you have thought they had a good moat or not really because there was competitors everywhere?
I'm not sure I would have been able to tell back then, to be perfectly honest. honest. The phones, I don't know. I wasn't buying a phone back then, so I'm not sure. But I mean, you would have been able to see the Steve Jobs presentation and the sales numbers from the iPhone, and you would have seen BlackBerry doubling down on their design and it not working. So I'm sure maybe you could have seen it coming, but I'm not. Yeah, I'm not too sure myself. Okay.
Sorry, more moats then. What are the other moats? We've got switching, patent, secrets.
Yeah, there's heaps. Brand moats and barrier to entry moats. So when an industry is so dominated, it's kind of like a monopoly moat. When it's so like cruise lines, there's only like 3 major cruise lines.
Supermarkets, Woolies and Coles.
Supermarkets, duopolies and monopolies. It's kind of weird. Like as a consumer, you hate monopolies, but as an investor, you love them. Like a monopoly will protect the business's cash flow better than anything else. And that's a very, very powerful moat.
Looking at Amazon, what do they have? What's their competitive advantage?
I don't know. I've never really looked too much into Amazon. Yeah, I don't know. I don't know really much about their business at all, to be honest.
Okay. Well, like Netflix, I know Hamish loves Netflix. I don't know if you've looked into it as much.
Yeah.
Does Netflix have any kind of competitive advantage now?
Yeah, Netflix is a very strong market leader.
Interesting, because there's so many other ones popping up.
Yeah, but the data is very strong backing Netflix as the market leader.
Okay.
So, yeah.
Yay, fun. You also mentioned management teams. What are we looking at there?
Yeah, so we've done step 1 and step 2. So we've understood the business. We've figured out whether it has a competitive advantage. And I should just say, actually, before we move on to management team, the second step in identifying a moat is to make sure the numbers back up the moat. So what the moat does is it protects the business's growth.
I like that, because a moat, when you think of a castle with a river around it, it's protecting it. That's cool. Is that where does actually come from?
Yeah. That's Warren Buffett kind of made up the concept of the moat around the castle for businesses. Yeah. So the other important step in the moat is actually looking at the growth of revenue and net income and equity and free cash flow over a long period of time and seeing, well, does it hold up? Is it like consistently above like 10% per year? And generally you find that the companies that do hit that criteria have really solid moats, whereas the companies that struggle to consistently grow over time, they generally don't have moats because obviously they can't just focus on solid growth because they're battling really hard with their competitors.
Another one I just thought of was like the airplane manufacturers, like Airbus and Boeing, because there's only 2 of them.
Yep, duopoly. Yeah. And massive barrier to entry. It's I would say it's almost impossible to start. You need so much money to start an airline manufacturer that just won't happen.
Yep. Scary.
Keeps them protected. Yeah. But obviously there's a downside to that with monopolies for the consumer, because obviously Boeing has had some scandals lately of safety on their planes.
That documentary is terrifying. If anyone's watched it, I highly recommend.
Do you know what it's called?
Is it like The Downfall of Boeing or something? It's just on Netflix, I think. But if you just search Boeing documentary, it was like a few years ago. I watched it in like 2021 maybe. And terrifying. Right. And there's been even more instances now with all the whistleblowers.
Yeah, somehow those whistleblowers keep dying. I don't know what's up with that.
Oh my gosh, no thanks. Because I fly quite a bit and it's a bit terrifying.
Yeah.
There's all the memes on TikTok as well being
actually, scratch that. We just forget that I mentioned a Boeing whistleblower. Oh, I don't want to be killed.
I see so many TikToks now where people are like, oh, it's a Boeing. I should have gotten an Airbus. And like, which planes does my airline use? So it's interesting. Interesting to see if it actually affects it.
Yeah, I don't know. But interesting. So should we go back to management?
Yes.
Yeah, okay. So we've done moat, we've done understanding the business, we've done competitive advantage, management. So obviously a ship is nothing without its skipper.
Let's talk about Elon Musk. You like Elon Musk?
Elon Musk, I do like him.
Is that why you were happy with Tesla? Because you're like, he's a great leader, he's a good manager? Is that the vibe we're going with?
Yeah, I mean, he is a good leader. He is very in tune with what the company's doing, and he's not perfect. His communication as a CEO is not great, but by watching him, you can understand that he really cares about Tesla and SpaceX, and he will do anything possible to make sure those companies do well. And that's what you want to see and typically you see it more in founder-led businesses.
Yeah, I was about to say I've seen the stats where founder-led businesses seem to do better. Is that true?
Yeah. I assume so. I don't actually know the stats, but all of the kind of value investing crowd, they love a founder-led business. It's not to say that, like, for example, Apple's a great business led by Tim Cook. Tim Cook's not the founder. So you can find non-founder-led businesses that have really strong management teams. But generally speaking, if the company is the CEO's baby, like Mark Zuckerberg and Meta, or like Elon Musk and Tesla, then that goes a long way to to strong financial success over time, because it's like a kid to them. Like they're not just going to let their kid die. They're not going to let their baby die.
So we've got an obsessed CEO. What else do you look at in management?
Well, the value investing approach when we're talking about management is trying to find a manager with skill and integrity. So you definitely, the manager is the head honcho of the company, and they're also the head honcho. Like when we invest in a company, we are giving our money. We're not giving our money to the company, but we're investing in this company, and then it's up to the management team to take this company and make it grow. And so we better be sure that when we're investing in a company, that manager is going to tell us what's going on and be honest and transparent. And a lot of that analysis comes through things like earnings calls. So listening to the earnings calls and how they answer questions. So for example, Elon Musk on an earnings call, he can answer any question that comes his way because he knows the company inside and out. If you're starting to get questions answered on an earnings call that sound like they're being answered by the US president, very political and kind of PR and not really getting to the point, that's where the yellow flags start to come in. Or if they get stumped, if they're just being asked questions and it's obvious that they don't know what they're talking about, then that's where you're like, oof, I don't know if this manager's really all they're cracked up to be.
Where do you join an earnings call? Can you just Google like Tesla earnings call?
I don't think Australian companies have to do earnings calls, but yeah, in the US, almost all of them do. I don't actually think it's a requirement, because now that I think about it, Berkshire Hathaway doesn't do earnings calls, but generally it's a 1 hour-ish call that they do that all investors can listen to, and it comes out after their quarterly earnings.
And how do you find the link to that?
Just on their investor relations page. So you just go, if it was Tesla, you just type in Tesla IR and it'll take you straight there.
Who's on the Tesla ones? Is it just Elon Musk, or are there other people as well?
No, it's Elon Musk and the executive team.
Okay,
yeah,
cool.
yeah.
So you get to know them well.
Like the CFO will normally be there as well, talking about the financials more. The CEO will typically be there, not in all cases, but yeah.
Do you look at the diversity management teams? Because I've read a few reports recently that show that more diversity, the businesses end up doing better. Or is that not something on the list so far?
I personally don't look at that. I'm not sure what the statistics say as to whether you should look at that sort of stuff. But
yeah, there's a really good report. Was it by Deloitte or EY? Maybe one of them did one about how companies perform when they are more diverse. And it seems like they were outperforming companies that had a lack of diversity. But interesting to have a read if anyone's interested.
Yeah, I guess the value investing approach is not so much looking at the diversity of the management team, but more like really analyzing the person, like whoever that person might be, like drilling down, is this person, do the numbers say that they are operating with skill, and can we analyze their integrity from what they say? So I don't know about the diversity. It sounds interesting though.
Yeah, worth having a read if anyone's interested.
Yeah.
How do you analyze their integrity? Is it literally just like they do what they say they're going to do, they're honest, they can answer the questions?
Yep, all that sort of stuff. Yep, answering the questions, earnings call, just like interviews, it's pretty easy to pick up. I think as humans, we have a good BS meter. Like you can kind of tell when you're getting BS'd. So just listening to them speak, reading articles, and just looking at their track record. Do they do what they say they're going to do? That kind of thing.
Yeah, nice. How long did you research Tesla for before you actually bought a share?
Oh, geez, I don't know. Research, probably 6 months, but my history with the company as a fan of it went a lot further back than that.
Okay. Yeah. So lots of time. You don't just find one and then next week decide to invest in it.
No, it's a slow burn. Yeah. Value investing, I should say most value investors, we're not stock trading. We're not doing anything like that. We're making maybe an investment every other year.
Okay.
Yeah. It's really infrequent. I can't remember the Charlie Munger quote off the top of my head, but it's pretty much just saying that investors, they just wait. Like 99% of value investing is just waiting.
Do you invest in ETFs as well, or do you think most value investors do invest in ETFs?
I do, yeah. Because just you can't deny the statistics, which I think we'll talk about in the next episode.
Yeah, definitely.
The statistics say that most people won't be very successful, and I'm early in my value investing career, so I wouldn't want to be stuffed if I turn out to be one of the many that don't do that well.
I remember reading, maybe you were telling me this, something about like most value investors have like one or two winners that end up making them the most money. What was that saying or quote?
Yeah, well, Warren Buffett spoke about this in his shareholder letter a couple of years ago, and he is hands down the best investor that has ever lived. As I said before, 20% returns each year on average since 1965. No one has done that before ever, and likely no one will for an extremely long period of time. And he is so honest. If you read his shareholder letters, he basically said in this shareholder letter that the whole success of Berkshire Hathaway out of the hundreds and hundreds of investment decisions, if not thousands of investment decisions he's made, whether to buy here, sell there, all the different companies that have come in and left his portfolio over time, he puts the entire success of the company down to 12 good decisions since 1965 that he has just held. So what you tend to find, value investing is typically not buy, sell. It's typically just buy and hold. Unless something goes wrong, then you sell because you don't want to hold something that the story changes. But typically what value investors find is that their success rate might be only 40%, or maybe even less, maybe 3 out of 10 they get right. But the 3 out of 10 goes so well over time that it more than accounts for all of the mediocre ones that inevitably people invest in.
Yeah. We're going to talk about soon, like how you actually value a share. We've missed out on that part, but is it hard at the moment because everything is apparently overvalued? Like, is the internet making it a lot harder to be a value investor? Like we've all seen the story of GameStop and that just skyrocketing for no real reason other than social media. Like that's not a very good stock to buy and it's very overvalued. How do you think that looks in the future?
Yeah, everything is reasonably overvalued at the moment, but that happens. But that's just part of the approach. Like even 5 to 10 years is a short amount of time in the stock market. So a lot of value investors just wait these periods out. And it's not necessarily about finding like great stocks at really bargain basement prices, because that these days is getting almost impossible unless you're really looking at a lot of stocks.
Is this part of a cycle? Like has this happened in the past where things have been overvalued, there's been a crash and then they go back?
Yeah, definitely. So we're looking less at like what the market does overall, but generally if the market tanks, a lot of good stocks tank as well. But yeah, it's just about waiting. In the overvalued periods, you won't be buying very much, but you keep up to date with the companies on your watch list, and then you just sit it out. And just if something happens that affects the whole market but doesn't affect your company all that much in the long term, then they're the opportunities that you get in. But yeah, it's 99% waiting.
How many companies would you have on a watch list? Like this sounds like a lot of research. If you're reading all these reports, you're watching all the earnings calls, like you're pretty involved in everything going on. Do you just look at 1 or 2 companies at a time? Do some people look at like more? What's a sustainable amount to keep on your watch list?
Yeah, you're right. If there's too many stocks, you run out of time. And it comes back to your circle of competence as well. Most people, their circle of competence won't be very big. Their profession at work will hit their circle of competence. They might be interested in 1 or 2 kind of things, maybe video games and electric cars. So maybe that goes into the circle of competence. But there won't be that many companies. And you'll slowly look at the different companies in the industry over time, but you'll probably find that 90+% of them you just put on the too hard pile, or you just won't resonate with you. So in reality, most value investors aren't looking at all that many stocks unless they do it professionally for a living. But that's not most people. Most people are just like looking after work or on the weekend, spending an hour or 2 reading. So like I wouldn't expect the everyday person to be tracking more than say 5 companies.
Yeah. And even that seems like quite a bit if you're trying to watch all these things. So big question, how do you actually value a company?
Yeah, so we've gone through step 1, 2, and 3. So I've done understanding the business moat, management, and then the last step is valuation. So originally Warren Buffett used to follow what's called the cigar butt strategy. So he used to look, cigar butt strategy. So he used to look for these, and this is from Benjamin Graham. Benjamin Graham came up with this originally. He used to look at these companies that were crappy companies, but they were just so cheap by valuation metrics that if you bought a diversified basket of these really cheap stocks, hopefully you get one last puff. And if you just get one last puff, it's fine because it's free and you've made money.
That's so gross.
It's a gross analogy.
There's not a better analogy out there, but sure, let's go with it.
And now that has changed over time. So Warren Buffett, thanks to Charlie Munger actually, learned that it's a much better strategy if you just look for not the cigar butts of the world, but the really wonderful companies that will perform well over 10, 20, 30 years. And instead of waiting until they are at bargain basement prices, just buy them when they're fair. So just buy them when, you don't want to buy them when they're egregiously overvalued, but just buy them when they're at a fair price and just look to the long term. And because in the short term, who knows what happens, but over the long term, share prices will even out to the success of the business.
When you say value though, like what is the value of a company actually made up of? Like how do you value a company? Do you read a number and you're like, this is what the company says it's valued at? When we might have like a WeWork thing, which we don't want, or do you actually go and find it somehow?
Well, the way value investors do it is they imagine themselves as the entire owner of the business. And when you think of yourself as you own the whole business, the number that becomes very important to you is the cash flow of the business. So how much cash is this business producing? And the analogy that I like to use is, say you go to some, dollar store and you see this money printing machine on the shelf, and you kind of tinker around with it, and you're figuring out what you're going to pay for this money printing machine. And so the question you probably ask is, okay, how much am I going to pay for this money printing machine? Well, how much money can this machine print in a certain period of time? So that becomes the structure of your thinking to figure out how much you'd be willing to buy this money printing machine for.
Is there a formula that you work off that? If it makes like X amount a year, this is what it's worth?
Yeah. So the formula that all the value investors will look to is the discounted cash flow analysis. And it's pretty much, it is mathematical, so I won't get too much into it in an audio podcast, but it's the concept of figuring out how much cash the business is earning now, doing your research to understand how well that company has grown in the past and whether you believe it's set to grow at a similar rate into the future, taking the cash, growing it, estimating its growth over the next 10 years. And then you're going to say, okay, I'm going to buy this now. I'm going to hold it for 10 years. So I'm going to get those 10 years of cash flows, and I'm going to sell it after 10 years. And imagine I'm going to figure out how much I could potentially sell it for by taking the free cash flow at the time and multiplying it by a free cash flow multiple to figure out the terminal value. And then from there, we have to discount the future cash flows back to what they might be worth to us today, because the cash flow that the company generates in 10 years is not going to be worth exactly that to us today, because we have to wait 10 years to get it. So it's that time value of money. So we've grown the cash flows out over 10 years. We figured out what we're going to be able to sell the business for in 10 years. This is all estimated, of course, but the example still stands. We then discount all of the future cash flows that we're going to get as the owner of the business to what they are worth to us today. So if we want to achieve a 15% annual return, then we need to discount that accordingly. And then we just add those cash flows together. So it's
okay. Yeah. So lots of like guessing what's going to happen in the future.
Oh, it is guessing. It is guessing. Yeah. Yeah. It's definitely not. And that's where the concept of margin of safety comes in. So none of this is assured. And to be honest, the best value investors go in knowing that their valuation is wrong. If you believe your valuation is wrong, you'll do better because you'll be more conservative.
How do you even like start with like finding how to decide how much to like estimate stuff in the future? Do you go off the past? Are you looking at other companies? Do you see what other people are doing? Because I feel like it seems a bit random being like, oh, this company might make this amount next year. Yeah.
So that's where you need to understand the business so that you can understand what they've grown at in the past. Value investors love consistency. So if you've looked at the past 10 years of a company and you see that they've pretty much consistently grown at 10% per year, they've grown their cash flows at 10% per year. I mean, of course you don't know because we're trying to predict the future here, which you can't do. But if it's still led by the same management team, they're running the company as they always have done, you'd say, I would guess that they would probably grow the business at 10% per year out into the future.
Yeah, unless you can see something coming like, I don't know, I always think of like Video Easy and Blockbuster when all of a sudden they weren't really a thing anymore because Netflix and online stuff were coming about. So I guess like looking into what's happening with the future too.
Yep. Yeah, definitely. And that's where the moat comes in. So if we spoke about Coca-Cola. Coca-Cola has a big moat, which means it protects its competitive position, which means it probably will be able to grow fairly consistently. And if for some reason something comes along, it's going to take a while for Coke to be dethroned as the number one soft drink.
And we're always going to be, unless there's like a huge research that comes out, but even then like people smoked for so long, even though we knew it was unhealthy, but like you're always going to be drinking stuff. Like with DVDs, we weren't always going to be renting DVDs.
Yep. And so having that competitive advantage protects the business, protects your future returns. And if something starts to change in the industry, which you can see the industry is probably going down, it will affect the company less. And you as an investor will have more time to see that coming.
So you only do it with really established businesses so you can see the history, or would you do this with a newer business?
I typically don't do it with new business. I've never bought an IPO in my life. I don't look at new companies because, you don't have that history. Having the history of their financial performance is so helpful.
So crucial, it sounds like, for all of this,
Yeah, because a lot of the future estimates come from what they've been able to do in the past.
Yeah. This all sounds quite challenging and not for me because it sounds like it requires a lot of effort.
Yeah.
But we'll definitely talk about that in the next episode, like whether you want to do this or whether it's better to buy ETFs.
Yep.
You've done courses on this. What's your course?
Yeah. So there's a lot of courses on investing that are very scammy. Mm-hmm. And so we really wanted to try and create a product that starts to buck that trend. So last year we created, so my YouTube channel is called New Money, and we created a company, New Money Education, which is an education business that's got 2 courses on there at the moment. One is all about passive investing, and then that's stock market investing for beginners. And then the second course is called Introduction to Stock Analysis, which is a full, I think it's about 7 hours of professionally edited content, which goes through step 1, understanding the business. Step 2, finding a moat. Step 3, understanding management. Step 4, we actually do 3 different valuation techniques, but the one I was talking about, the discounted cash flow, is in there. And we just make sure that we take everyone through every single step they need to know, including the risks, including how they can minimize their risk of losses, that kind of stuff. And yeah, that's available at New Money Education.
Why is yours not a scam?
Because I would not make a scammy product.
No. Well, like you're licensed. You made courses before, you redid them. This is like the second kind of like second edition maybe. You're licensed by Guideway like I am.
Yep. Yeah, that's true. And also like it's just not in my nature. Like I wanted to make this course just leave no stone unturned so that anyone, it doesn't matter if you know nothing about the stock market, you will be able to understand every single thing in that course. And it's very well structured so that we go step by step so that we just keep building up that knowledge. And of course we use examples throughout. So there's never going to be a time where I just talk about some concept as I don't get that. Like there's always going to be an example. Okay, let's look at Apple. How does this relate to Apple? How does this relate to Meta? So hopefully, I mean, the feedback we've got has been really, really good on the courses. We had feedback actually from a professor of valuation at a university in Texas.
Pretty cool.
I was so nervous when I spoke to him on the phone because I was like, oh, please don't roast
I've
my
gotten
content.
everything wrong.
Yeah. And he said, dude, this is the best stuff that I've seen. And I want to try and get this course to be part of the curriculum as part of the learning content that he uses with his students. So that was really, really nice. I'm very glad that he said that.
Yeah, well, it all sounds very good. If anyone wants to learn more, there's definitely those courses. They can watch your videos, and we'll be doing another episode as well about value investing versus ETFs or passive investing.
All right, sounds good.
Thank you for joining us.
Oh yeah, thanks for having me on. Much appreciated.
Bye.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.